Turkey's not going to be resolved relatively soon, but I think the conclusions people are drawing are probably going overboard in some areas and probably reasonable in other areas. Turkey is less than 1% of global GDP, and you've been talking about Turkey every day this month, and it's a small economy. It doesn't have big contagion impacts, but I think it's creating a psyche for emerging market investors where they realize the carry trades they've put on, the growth they've looked for, comes with risks, and I think that's still got a ways to play out. So I wouldn't be looking to add emerging markets right now, even though I don't think Turkey has any contagion impact on the rest of the emerging markets. I would be putting risk on in developed markets, though, that are caught up in the Turkey trade. So European industrials are benefiting from the weak euro. The euro's got a lot weaker because of Turkey. European banks have exposure to Turkey's debt, but they don't have as much as the share prices have fallen, so things like that. And treasuries in the United States. I think the economy in the U.S. is going to continue to be very strong. People have put a bid in on treasuries. I think now is a good time to get out of treasuries or put shorts on treasuries. So Turkey isn't as important with real contagion, but I think it still has that psychological impact on emerging market investors for probably the next few months anyway.
As a percentage of GDP, banks in Spain have the greatest exposure to lira, Turkey's currency, denominated debt and other debts. And they have been sold off, particularly BBVA, one of the biggest banks in Spain. Has that sell-off been overdone, Patrick? It sounds like you think it has.
It has. We're not buying the Spanish banks right now. I'm more playing a middle ground in the French banks. I really like BNP. On our estimates, 2% of BNP's valuation comes from its Turkish business. It's got Turkish loans that may default, but you're not going to lose everything on those. So I think it's maybe got a 5% impact on NAV in a worst-case scenario. The market's down 10% month to date pretty much on BNP. You're getting a 4% dividend yield. Its capital ratio is 12%, almost 11.9%. So it's a safe bank that's probably being hit too hard right now. So I wouldn't chase the Spanish banks just yet, but I think the French banks are more of a sweet spot where you have some exposure, but a little less downside.
Might have been a case of sell first, think later. I want to focus on one country specifically, though, because all the major markets in Europe rose today except for one, which is Italy. You know, obviously, aside from that horrific bridge collapse they had, the company has structural political problems as well, debt problems as well. They continue to change administrations, kind of kicking that can down the road. Italy falling more than 1% today while everything else rose. Are you worried at all about Italy? Italy, unlike Turkey, is a massive global economy, 8th biggest in the world.
Yeah, it's a significant European economy. I don't think the tail risk people are worried about with Italy are going to come to fruition, but you've got a party that's popular right now in place that has got very different agendas. You've got a socialist party combined with a right-wing party, and both of them want to put populist policies in place. The market doesn't like that uncertainty. I think they'll probably come to some sort of deal where they say their deficit will be X, and the deficit will be bigger than that, and the European Union will probably let them get away with that for a little while to appease the voters and not really rock the boat too much. So we're not buying Italy just yet, but the tail risk that people are worried about there probably won't come to fruition.